Hi, thanks so much for joining in. You're watching Your Money Matters on NDTV Profit. My name is Alex Matthew. Today I'd like to talk to you about credit risk and the fact that a lot of you have perhaps considered or have actually gone ahead and invested in corporate bonds that are available on applications like Wint Wealth and India Bonds and certain other applications. Is this something that you should consider doing? What are the dangers involved? We'll also talk about credit risk funds and the concept of buy now, pay later. We've also got tips and tricks for you to decide how to save on your electricity bill. All of that and more on today's program. But first, let me introduce our expert for the day. We've got Mrin Agarwal, who's financial educator and founder at FinSafe India. Mrin, thanks so much for taking the time. Let's start with the first topic, which has to do with buying of corporate bonds. Now, I've actually seen this, and I have anecdotal evidence, people going out and saying an A-rated corporate bond is available at a yield of 13% or 14%. And people think, wow, this is a fantastic return. It's a 4-year bond. Why don't I go and invest in it? What, according to you, are the risks involved, and is it captured in the value that you're getting?
So good evening, Alex, and lovely to be here today. And well, I think that a lot of times people are investing in these bonds, just going by the names of the companies and thinking that they have heard about these companies, but these bonds come with huge amount of risk. And of course, the biggest one, you mentioned a single A bond. I was actually surprised to see that BBB- bonds were also being sold on some of these online platforms. And mutual funds typically invest in A and above. And if you look at most mutual fund portfolios, you would find very low incidence of single A rated bonds, right? And here you have bond platforms where you have the lowest quality of bonds that are available. So obviously they are going to come with a default risk. And platform is not going to help you in case of the default, right?
But let me stop you there, because I know that a lot of my viewers will be aware of this, but let's drive home this point, right? We've talked about certain letters. We've talked about A-rated bonds. We've talked about BBB- rated bonds. These are effectively credit ratings which are issued by credit rating agencies. But Mrin, BBB is investment grade, and anything below that falls into dangerous territory. In fact, anything around that investment grade is also not out of the water in terms of the danger of default. And default means that you don't get your money back, correct?
Yeah, that's right.
So explain how that works. When you're talking about falling low on that rating scale, the company gives you more money because it's trying to compensate you for the risk that you're taking. It's as simple as that, isn't it?
Yes, absolutely. And in fact, see, most of the companies that are borrowing are NBFCs. And what they do is that they further lend out these monies, right? And typically, the credit rating that they get is dependent upon, how their business is doing. So if they've got a lower credit rating, it basically means that they have a moderate asset quality or moderate profitability. They could be asset liability mismatches, or they could be companies who are fairly new in the business. What it really means is that things could go wrong, and that means that you could end up losing money. And let's not forget that in the last 5 years, we did see two AAA rated bonds also defaulting and investors not really getting much of their money back.
Yeah, you're talking about IL&FS, right?
And Divan Housing, yeah.
Yeah, so these two entities. Now, let's talk about the other aspects as well, because one, you're effectively I feel that you're taking a certain amount of risk that can be compared to equity risk, because when you invest in equities, there is a possibility that all of your money gets wiped out if the company does not do well. But that's not something that you normally do when you're putting money into a bond. But in this case, you would have to be aware of the quality of the company that you're investing in, the debt of which you're investing in as well. So the question that I have for you is that when you look at that and you look at the tax treatment of this, effectively you're going to be paying slab rate, which is, if you're in the highest tax bracket, you're paying 30% tax on the interest that you earn, even if it's 14%. So you're not getting that much anyway, right?
So that's the whole point, Alex, right? That in most of the cases, you have to hold this bond till maturity. And if you do that, what it means is that it's going to be fully taxable. It is only in case of unlisted bonds. I'm sorry, it's only in case of listed bonds that capital gains is applicable. But the point again is that most of these bonds are not really widely traded for an investor to go sell it off, right? So there is a liquidity risk, there is default risk, and on this whole aspect of comparing it to equity risk, I don't think that it's correct, because at the end of the day, you could lose money in the stock, of course, depending upon the financials of the company and all of that. But I think first of all, you can't compare a bond with equity, right, in the first place. And these bonds come with various other risks, like we've seen in some of the cases that there are subordinated bonds that are available. A lot of times these bonds are being sold saying that there is a collateral that's available, but we know how difficult it is to call the collateral, right? So on this whole comparison, saying that instead of putting money in equity, let me put money in a bond which is secured, right? Because there then maybe I'll not be able to lose my principal. The reality is that we know from past instances how difficult it is to call the security and to enforce the security, and for investors to really get back their money. So I think this is not a good.
Yeah, but the point that I was making, I wasn't really comparing equity and debt. What I was trying to say is that if you are going to take on that kind of a risk, then you may as well invest in equity. Why would you go and venture into the far end of the bond market to try and get similar returns when you can invest in good quality companies and get similar returns with better taxation? If you're going to take that kind of risk, and you're actually pointing out that the risk that you're taking is higher in certain cases than you would take in equity.